Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Maxime or Max Laurent-Bellue, Group Deputy Chief Executive Officer and Co-Head of Credit at Tikehau Capital. Max, I really appreciate your time today. It's nice to meet you. How are you doing? And of course, thanks for joining me.
Thanks, Todd. Very nice to meet you as well, and very happy to be speaking with you today.
So just to kick off, I know we've had a little bit of a volatility in the markets. Certainly here in the U.S., we've contributed to that with the new administration and Liberation Day and all the tariffs, and then we've also had conflicts. When it comes to the uncertainty that we've seen thus far, is that starting to reshape investor appetite for European alternatives? And are European investors looking at Europe as say a safer bet today?
Yeah, I guess it's fair to say the past few weeks have been a bit bumpy on many fronts. I think there are two questions here. I wouldn't say that Europe is necessarily seen as safer right now. I'm not sure safer is the word I would use, but for sure more attractive, definitely, which is slightly different. I guess although historically Europe has been growing at a lower pace than the US, obviously, and then Asia, but I think it remains a very large, very fragmented and dynamic investment playground. And I think the most important thing is there are very different backdrops at play in Europe, in different places at the same time. So whoever basically has the having the platform, the setup, the people to address this holistically can extract a lot of value. So I think that what makes Europe more attractive or interesting these days is maybe that the largest allocators have been simply underweight Europe for some time now. And obviously, as you said, the recent macro and geopolitical turmoils, whether we're talking about tariffs or the wars, have been a bit of a wake-up call. Wake up call for Europe first, in a sense that Europe as an economic zone needs to invest broadly for its sovereignty, right?
Yep.
And that includes tech, AI, defense, energy, and that's been very clear recently. But also wake up call for investors and LPs, I think, globally, that the recent uncertainty probably put the spotlight on the need for stronger diversification. When you own a business, or when you run a business, or when you build an allocation, diversification is usually a very simple and basic rule, but it's still a fairly efficient one. Yeah. I think that's the main driver here.
So private credit has clearly been a big buzzword the last few years. What's your view on the risk return, kind of trade off in private credit versus traditional fixed income? And, there's always been a premium for private. Does that begin to get eroded over time?
Well, it's fair to say again that there have been a substantial inflow of capital within private credit over the past let's say, decade or the past 15 years. The asset class was really, at least in Europe, was really born or emerged on the back of the GFC. It's been growing at a fairly incredible pace. And yes, returns to some extent have been tightening recently. But I think same applies to most of the fixed income spectrum. And usually there is still some level of correlation between these markets. Yes, private and liquid public markets are different, but they are correlated. So I think that the premium is still there, and I think there will always be one. Otherwise, it just doesn't make any sense. Whether the premium narrows or not in the near future, I think it's very hard to say. But I personally think it will remain. That is just about the returns. I think the only comment I would add is that the appeal for private credit, I think, comes from various aspects. And it's not just about the absolute returns you can extract from it, but it's also about, the better protection, downside protection, the stronger documentation. For some investors, the solvency treatment, which is attractive, less volatility, and so on and so on. So yeah, from a return standpoint, I do think that the premium will prevail, even though sometimes you're in a context where absolute returns tend to tighten.
Looking a little bit, stepping back a little bit on kind of the wider European private debt market evolution. You have rates and regulations are shifting. Rates have gone up. Now they're starting to come down a bit. More capital has gone private, in the last few years. Where would you say some of these trends are heading? Are we continuing on the path of some of these trends the next couple of years? Do you think some of these will change? What's kind of the broader view on the debt markets and kind of where they're heading the next few years?
I think the first comment I would make is there is no doubt the market will continue to grow as a whole. I think it will continue to grow, if I may say, organically and non-organically, i.e. within the existing asset classes or sub-strategies, but also, I'm sure we'll discuss further, but in other or new territories, if I may say. And I think the main reason is simply because it's an attractive asset class. Investors have been discovering it. They've learned to understand it, like it. It's been tested to some extent, even though, yes, we haven't 50 years of that we can look back in terms of, defaults, recoveries, and so on. But still, it's been through a certain number of turmoils, and it's been performing relatively consistently. So on the rates, yes, as you said, rates have been, after many years of, zero rate environment, if not negative, they've been increasing sharply and quickly. And I think that was to the benefit of the asset class, right? Because most of private credit is variable. So it was another feature that's usually in search when people allocate to the asset class, is that it's supposed to be inflation proof. Now they're going down. I think that will probably be to look at the half full glass will probably be to the benefit of the borrowers and put some relief in the structures, which is not necessarily a bad thing. So overall, I think the dynamic, the long-term underlying trends and dynamics remain supportive. On the regulation point, I'll be brief because it's very hard to project anything. But yes, there have been a lot of talks recently about regulation. I do think the asset class is regulated still, and it's not the black box that some people want to describe it as. I do believe there will be more regulation in the future, for sure, simply because if it keeps growing, as I think it will, there will be a need still for more regulation. But I don't, again, personally believe that the asset class pose a potential systemic risk issue. And again, there have been talks about that recently. I think most of the global systemic financial crisis recently have been liquidity crisis mostly, and I don't think that private credit can lead to a major liquidity crisis.
So you're the group deputy chief executive officer and co-head of credit. Kind of what falls under your remit, and then for those who might not be as familiar with Tikehau Capital, what does it look like today?
So yeah, so basically, I've spent my entire career working in credit. Today is the largest business line that we have within the firm. We manage close to 24 billion in private credit, and this is spread across different strategies. So my oversight is really focusing on some of these, in particular, structured credit, special situations, and real estate credit, which are the main focus. And yeah, so as I said, it's the largest business line. It's a strategic asset class for us, where we think we will continue to grow on a global basis. And we think it will remain a core growth engine at the firm level. And again, as I said, the intention and what we will, our key objective will be to continue growing and scaling our existing strategies, including the most mature ones, such as CLOs and direct lending, for instance. But also in the same time to add further strategies and building blocks.
A couple of minutes ago, you had referenced the borrowers, and curious to hear how borrower behavior has been changing. Credit conditions have gotten tighter, rates have gone up, they've gone down, and how does that ultimately impact your underwriting approach to borrowers?
Yeah, I think borrowers are getting simply more and more sophisticated, as a result of the asset class itself that's been growing and developing and being more sophisticated. Borrowers have adapted to it, trying to optimize terms, put competition at play. I think the two main illustration of this is probably the rise of intermediates that are now operating in the market, such as debt advisory, equivalent to M&A advisors, but for debt. And also on the sponsor side, more and more, the sort of capital market function is internalized with dedicated teams, not working on the deals, but working on the financing, putting together the financing. So for sure, this is one of the recent evolution. In terms of the other comment I would make is that borrowers are reacting very differently when there is an underperforming situation. They are potentially more or less proactive. Some are very proactive, and some are more in a denial mode, avoiding as much as possible talking to the lenders. It's funny to see that in Europe, the bulk of the underperforming situations are actually decent businesses. But it's just businesses that don't have the right capital structure, used to be sustainable in a cheap cost of funding environment, not necessarily sustainable in today's environment, with higher operating costs and higher financing costs. And we see a very different behaviors in that sort of environments. In terms of how our underwriting has been adapting, I think we we see an increased divergence across the board between sectors, the more resilient sectors or the more attractive ones, or and on the contrary, the more cyclical or the more affected sectors. But also within each sector, there are very more and more differences between issuers. That creates a premium for asset selection. I think the focus and our underwriting has been more than ever focused on asset selection, picking the right sectors and picking the right issuers. And similarly for structures, we are simply being more and more cautious on how we structure our deals, putting the right level of debt, making sure the level of debt that we underwrite is sustainable, and not taking for granted that an easy refi will be done on the cheap in a few years' time.
So that kind of plays a little bit into my next question, which is around LPs, and the environment is clearly has gotten that much more competitive. Private credit has grown exponentially the last few years. How do you differentiate the Tikehau platform, the Tikehau advantage versus a lot of other asset managers that are in direct lending or CLOs or other strategies?
I would bring up 4 key points. The first one, which is at the core DNA of the firm, is really centered around alignment of interest. The firm is structured around our balance sheet and asset management business. The balance sheet has been and will continue to invest heavily within our flagship strategies, which means that we are not just an asset manager, we're a principal. And we put our money at work alongside our LP's money. Key point, I think, when it comes to third-party management. Secondly, we've been historically focusing on the core mid-market across our various strategies, whether we're talking about direct lending or capital solutions, special sits, or even real estate credit. We focus on core mid-market, where we think we get very strong origination, better terms, and better documentations, and we've been very consistent in that approach. Thirdly, the platform that we've been building over the years, we think, is differentiating in itself. It's a comprehensive platform. We don't do everything. I mean, we don't do distress, we don't do NPLs, but we tackle a fairly broad array of strategies, which are actually very synergetic with one another. And essentially, we offer a platform which is a one-stop shop for our LPs and for our counterparts or borrowers. Lastly, and echoing my comment on Europe earlier, we have a very local approach, very local platform. We've been operating locally in all of our markets since the inception of the business almost. So wherever we deploy capital, we have local teams, local origination and execution capabilities.
Of the alternative asset classes, is there a particular one, or where do you think is the greatest value today in your view, and why?
Are we talking credit here, or?
Yeah, credit.
It's hard to isolate just one, honestly. If I had to, I think I would bring up secondaries.
Okay.
Credit secondaries. Main reason, and to your question, why, I think it can only grow considering the growth of the underlying asset class and markets. Also observing what we've been observing with PE, right? And how secondary PE has been growing and is now a very recognized and well-known and appreciated asset class. I think the same will probably apply to private credit secondaries. I'm convinced that as the asset class will grow, need for secondary market will only increase, and also simply looking at the potential returns for the asset class versus the embedded granularity, and the very attractive distribution profile of the asset class makes it simply very, very interesting.
It's funny you say that because I just interviewed someone, I think it was earlier this week, who's in secondaries, Pantheon, and they had said, the growth of that since 2019 has been pretty massive. And a leader, a space that you guys are certainly a leader in, and maybe it's not as big of a space here in the U.S. is sustainable finance, and I know it's always been important to the firm. How do you measure that tangible impact in private credit when it comes to sustainable finance?
I think the most effective way to measure this is simply applying or providing sustainable linked loans, right? So whenever you provide a loan, you apply margin ratchet essentially, which is ESG based, which is a field where we've been, I guess, one of the pioneers for sure, and it simply directly ties the borrower financial term to measurable sustainability improvements, such as emission reductions or enhanced social outcomes. It can be anything, and obviously you adapt this to the nature of the business. But in the end, it's a proper incentive based on quantitative and qualitative features that is actually impacting positively or negatively the cost of financing that the borrower will be paying. So it's very concrete, very tangible. It's real, simply. It's legally binding, obviously, as an instrument, requiring annual reporting, very specific KPIs that you follow, monitor, update, and which ensure transparency, accountability, and a properly measurable impact. That's the main and most efficient way to act on this, I think.
When it comes to innovations and structuring and origination, is there anything particular you think could help define this kind of next wave of private debt? Obviously, we've gone from the last few years, a lot of these markets have grown exponentially. Is there something in the next few years, say the next 5 years, next 10 years, that might define what private debt might look like then versus what it might look like today?
First thing I would bring up is I see a lot of new verticals, new adjacencies that are developing or could develop going forward, could weight more in the broader mix of the asset class, and that should definitely catch up over traditional private credit strategies today. And the one I can think about are probably digital infrastructure is one. Data centers it's a big thing. It's a mega trend to some extent. We have been involved recently over the last 3-4 years in several deals. We've been providing loans to ensure the construction in data centers across Europe in 3 different jurisdictions. Each time sizable loans, usually 3 digits. And for obvious reasons, the growth in demand is expected to only continue, right? So, and this is not yet a very precise strategy, right? But I think it will contribute to the growth of the asset class, developing a proper new segment. Same applies to real estate, I think. We are convinced that there is a fairly large funding gap in real estate credit. Historically, there haven't yet been a GFC moment, I think, for real estate credit. And the recent couple of years might be a good catalyst for fueling the growth, the future growth of this subset. I'm thinking investment grade as well. That is also certainly something which is quite topical, whether private credit will penetrate IG. So all of these, let's say, new subsets, I think will certainly play a part in the future of private credit. The second thing I would mention is obviously, it's a bit different, but it's obviously AI, right?
Yeah.
AI is the elephant in the room. There are multiple potential applications across the entire investment process that we can think about. AI can be an enabler for screening companies to be integrated in the investment process, also in the portfolio monitoring potentially, to be a sort of playing a role in signaling early some potential underperformance. There can be lots of applications. I think we're very much at the beginning of this. It's a bit it's an obvious statement, but I think it truly applies to private credit as well, and will certainly be part of the next decade in the space.
So you mentioned obviously some of the asset classes there and new technology. Is there any particular regions, whether it be the Middle East or Asia, that you find are poised for significant growth, in the next few years, next decade or so?
In terms of, you mean in terms of deployment or?
Yeah.
Certainly. It's interesting you mentioned this because we've actually recently launched sort of Asian direct lending business.
Interesting.
We think this is certainly an area where again, very, very dynamic, same as Europe, very fragmented, right? But still early days, but there is no reason why the asset class shouldn't develop and grow and accelerate in Asia. Middle East, same in a way, although we don't have a dedicated strategy yet. We have been operating locally for the past couple of years. Our office is growing fast. We are developing the ecosystem there, and the ecosystem is obviously the LP ecosystem, but not only, right? The more entrenched you are in any jurisdiction, at some point you end up seeing deals, right? And our core reason to exist is whenever we are operating, wherever we have an office, our mission is to raise capital locally and ideally to deploy capital as well.
Yeah.
So we again, same, very dynamic region, higher probably superior growth, and certainly an avenue for future growth for the asset class as well.
So we have just a few minutes left. I like to end with some fun questions as we wrap up. So
I like fun.
So do you have a favorite sports team or hobby?
Yeah, one each, I guess.
All right.
Sport team, PSG. Born and raised a PSG fan. And hobby, I would say golf. And actually both are headaches factories, right?
What's your handicap in golf?
25. So
okay.
Unfortunately, I've started a bit late. So
well, as long as you have fun, right?
Exactly.
Tell us one surprising thing about yourself.
Believe it or not, I've never watched Forrest Gump. I have to.
Well, I would certainly recommend it for sure.
One book that you'd recommend reading.
I like history, so I want to say Churchill biography. I've read a few. Fascinating man story history.
The most exciting part of your job.
Constant movement.
And then final question, one prediction for the next year.
So 25 was, I will stay in the fun part, but 25 was the PSG year. So I will say that PSG will win a second Champions League in 26.
Well, I appreciate your fun answers there at the end. Appreciate your time, Max. Thank you for joining me. Continued success to you and the team at Tikehau Capital.
Many thanks, Todd. It was a real pleasure, and thanks for your time as well.
Thank you.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.